Okay, part two, analysis and interpretation of financial statement. And here we are just going to spend our time talking about the ratios. They are quite important. Obviously, ratios should not be taken in isolation. It is important to compare them to result of previous years, to compare them to other figures in the financial statement, as well as to look at similar entities or companies in the industry, especially in the case of a benchmark. So you would often hear about an industry benchmark. So it is in that case that these financial statements should be analyzed. Obviously, this is important to many stakeholders, especially investors, right? So let's look at some classes of ratios. And we, for example, have the solvency ratios, profitability ratios, liquidity ratio, asset management ratios, gearing ratios, and investment ratio. With regards to investment ratio, we will more focus on the gearing ratio, investment ratio, liquidity and profitability. Liquidity and profitability. But remember, it's not only the investors, there are also creditors that will be quite interested at, at at the financial ratios of a company, right? So let's go straight into solvency ratio. And you have one that is quite important. You have the total asset divided by the total liability. What we want to find out here is if the company is able to settle all its debts or liabilities with the use of the total asset. So it's quite significant. So if that's the case, then we would say that the business is solvent. And if not, that's not the case. If the liability is greater than the asset, then the company is insolvent. All right, so then let's look now at profitability ratios. We are looking at gross profit percentage. It's fairly straightforward. We take the gross profit, we divide it by the total sale, multiply by 100, right? So we're getting a percentage. But what it indicates, it's how effective the company is at selling its product. So that's what it's all about. How effective the company is at selling. Obviously, the greater the percentage, the gross profit, the better the company is doing at selling its product, right? Another one would be the net profit percentage. We take the net profit, we divide it by the total asset, multiply by 100, right? Here we want to see how the company manage, how well the company manage its cost in order to generate profit. Another one would be also the return on average owner's equity. Average owner's equity, meaning that if we are given 2 years, we're gonna add them up together and we divide by two, right? Because it is an average that we're looking at. So re return on average owner's equity. Net profit divided by the average owner's equity, by the average owner's equity multiplied by 100. We want a percentage, right? So average, again, we could take at the beginning of the year and the end of the year. We add the equity together divided by 2. But what does this say? What does this point to? It is good to see what's the net income is compared to the shareholders equity or the average shareholders equity. It's quite important to see that, and it is a profitability ratio, right? We quickly move on to liquidity ratio. Liquidity, money. Obviously, current ratio, acid test ratio. If you've gone through previous videos, I expand quite a lot on this. But again, it's about the company's ability to settle this time short-term liability because we're talking about cash, right? Short-term liabilities with short-term asset. Obviously, we don't want to settle short-term liabilities with long-term assets, right? Or non-current asset. We want to settle it with short-term asset. Remember again, there is that balance sheet, asset plus, um, or rather asset equal to equity plus liability. Asset equal to equity plus liability. Accounting 101, right? So you remember that, you remember the balance sheet. Obviously, all these ratios will tap into it. For example, this one specifically, we're looking at the current asset and the current liability. And what is the current asset actually made of? It's made of cash, it's made of inventory, it's made of trade receivables, right? Our debtors, they will need to pay us, right? Because we traded with them on credit. So we are expecting future payments. So we have the cash, which is the cash payment, and then we have also the credit that we are to um, receive. So which is the trade receivables. So we are to receive in future payments. I trust that that's clear, right? So in any case, the current ratio, the best thing is that we want that it be 1 1, meaning that, or above 1 1, meaning that our current asset can settle our current liability. Another one, the acid test ratio, it's also known as the quick ratio, very quick. We want to find out. And what are we concentrated on? We are concentrated on the money part. So we take the current asset as it is, we just remove the inventory part because the inventory part has not yet been converted into cash, right? So that divided by the current liability can give us a good indication as well of our ability to settle quickly our current liabilities, our company's ability to quickly settle, sorry, our current liability. That's why it is a quick ratio, right? Very important. We quickly move on to the asset management ratio. Remember again, do your reading, do your practice, very important. But we are looking at something that actually speaks to what we just looked at, the liquidity. There is an aspect of it, in order to fully understand it, it's also the asset management part that comes into play. We are looking at the average data collection period because remember again, there is that trade that is on credit, future payment expected, right? So it's quite important to know what is the average data collection period. Average data collection period. We're talking about a period, and that's the reason why we are using the 365, which is the yearly. We're looking at the year, and that's why if we're looking at the year at a period, we have to always to think about an average. And that's why beginning of the year, end of the year, if we have those, we can add them together divided by 2. So we will look, for example, for the average data collection period, we will look at average trade data, all right, trade receivables, our datas that will pay us. We look at the average trade data divided by the credit sales, not credit purchases, because this is about the datas, right? The people we are selling to. Okay, the people who are selling to us are our creditors. They are selling us on credit. The average creditor settlement period now comes into account. Remember again, the difference here is the data collection, we collecting, and on the other side, we settling with our creditors or purchaser, suppliers, and so on, so forth. All right, so we take the average trade creditors, we divide by the credit purchases because we were purchasing on credit, right? Average trade creditors divided by the credit purchases multiplied by 365. Remember that because we are looking at the period in terms of days. We want to see a period, a length, right? So the average length of time that it will take for the company to settle its trade purchases. Another one that is quite important is the average inventory turnover. How many times in a year does it take to turn or to sell our inventory? So we take the cost of sales. The cost of sales we divide it by the average inventory. And again, Thus, what it says is, the best way for you to remember this, to, like I said, to make it part, a second nature to you, is by doing the exercises. And such exercises, for example 2.6 is a good one. You look at it here, they provide you a statement of financial position, which is a balance sheet, statement of financial position. Like we said, asset equal equity plus liability. You can see asset on its own, equity plus liability. You have equity, owner's equity. You have non-current, current liability. You have non-current, current asset. Very important. And they give you for multiple years, right? For 4 years here. And they also provide you an income statement, right? Sales, less cost of sales gives you gross profit. They're adding the other incomes and the minusing the other expenses, which gives them the net operating profit for the year, right? And they provide you the notes. These notes are not to play with. They are not just there for um, decoration, right? So they are here and they mean something. Here, for example, they provide you information like the markup, which is 50%, sorry, of the cost. 80% of all sales are on credit. This is very significant, all right? So all sales, 80% of it is on credit. That speaks a lot. 75% of purchases are on credit. And then they specify also that the purchases are only 60% of the cost of sales. So when you're looking at the cost of sales, you need only to deal with 60% of it, that is purchases. And from that 60%, you take another 75%, which is only on credit. I hope that this rings something in your mind. So it's not the entire cost of sales that you need to use. For example, when you're doing the turnover, the one that we were speaking, the average inventory turnover, you have cost of sales there. Um, but what you need to see is that we will use the entire cost of sales. That will not be the case when we talk about the average creditor's settlement period. It will be interesting to see the credit purchase, and that's what they give you in this example. They say only 60% of this cost of sales, 60% of it was actually purchases that we made, and only 75% of that 60%, 75% of that 60%. So you need to multiply 75% times 60% times the cost of sales in order for you to get the average the trade creditors, right? So very, very, very important not to neglect. And this is the solution obviously is next to it, like I said. But here are some of the solutions that have been provided. For example, for the solvency ratio, they provide you for 3 years, right? 2022, 2023, and 2024 for the total asset divided by the total liability. Then you can basically see the trend, and this is what it's all about. They want you to see the trend. If you see from 2022 to 2023 and to 2024, it seems like it's rising, which is good news, right? It is good news. It makes our company more solvent, right? And if you look at the profitability ratios there, you can see that for the gross profit, we're looking again at that trend, 2022, 2023, 2024. You can see I've shown a downward uh, arrows, I've shown downward arrows to say that it has been going down. So the gross profit percentage has been going down. And what is the gross profit tells us again? Remember, if you remember correctly, how good, how efficient the company is at selling, right? And we can see that the company has been losing in its efficiency. There was a markup of 50% that was we were told, right? And it remember if you remember very well in part one, it didn't result automatically. It's not resulting automatically in profits, in significant or increasing profits, right? one need to look at the cost of sales, right? We spoke about it, but let's go quickly to the net profit percentage. We can see also that it is decreasing. And remember, for the net profit, we were talking about how good a company is at managing the other costs, right? So we can see that this company might have a rise. So let me again repeat that. So for the net profit, when we're looking at the net profit, we can see that it has been decreasing. It's again about how good the company is at uh, managing the other costs, right? So there is definitely the company has an issue. Could be that there is a rise in operating expenditures, right? And that is something to look at. Liquidity ratios. Oh, before liquidity ratio, we were talking about that return on average owner's equity. Very important. Where we were taking the net profit, we divide by the owner's equity and average. Please, average, meaning that we need to look at the average. If they give you 2 years, you take 1 year plus the other year, like it's being done, divided by two, so that you can obtain an average, right? And we can see also a decrease there, and that's quite concerning, right? The decrease in gross profit definitely is impacting the decrease in gross profit, and also maybe the increase in operating expenses. It's definitely impacting the return on average owner's equity, right? Liquidity ratios, obviously, remember we have our current ratio and our acid test or quick ratio. Remember again, you have the formulas. Look again at the trend. You can see that there is some sort of an increase from 2022 to 2024. There seems to be an increase, which seems to be like a good thing, right? It is somehow a good thing, but should not be taken too much in isolation, because we need to look also at other ratio, and one of those ratio is the asset management. There is a mistake actually in your textbook, as you can see it, not asset management, right? So there is a mistake there. But let's look at what has been going on. We can see that the average data collection period has been increasing since 2022. It has been increasing. So it's harder and harder to collect from our data, and that is significant, right? But also, when we look at because obviously if it's taking us long, it's going also to affect us, how we settling our debt toward our creditors. And as you can see, it has also been increasing. We've been taking too long. I'm talking about this company, obviously. It has been taking too long to settle. So it started in 2022 with 51 days. It rose in 2024 to 62 days. When we're looking at the inventory turnover rates, remember cost of sales divided by the average inventory. You can see that we were provided the average for the industry was 12 turns per annum per year, 12 turns. But you can see from 2022 it fell drastically to 6, which is not really, it's which is below the average, and it is a problem, right? It was doing well in 2022, but since and slightly in 2023, but then in 2024 it fell, and that's a problem, right? Inventory days obviously can be also calculated. So the inventory day, we are told, is we take the number of days in a year, 365, we divide it by the inventory turnover. All right. So in our case here, the inventory turnover rate is for 2024 is 6.15 times, right? So we take 365 divided by uh, 6, right? And we can fairly get for 2022, it's 22, and 2024, it's 60 days, right? So we went from 22 days to 60 days, right? And it could be obsolete inventory that might be affecting this company and its because it's taking too long. It's getting too long. It's starting to get too long to sell the inventory, right? It could be, like I said, it's a speculation. If you see this confirm the early speculation that obsolete inventory may be the reason for the decrease in gross profit margin. And I will leave you two many examples. So again, like I said, you have the examples and you have the solutions next to them. Attempt them, okay? Do some exercise. As a tertiary student, you should enjoy this, right? But investing in shares, before we go to gearing, we were talking about gearing, if you remember. Before we go to that, let's talk about investing in shares. And this was part of the exam, by the way, okay? The three most common ways to invest, right? You can either purchase shares directly on the primary market. Companies have prospectus, and whereby potential investors are invited to take up shares at a specific price. So that's the primary market. The secondary market will be in South Africa, the GSC, the Johannesburg Stock Exchange. So um, there you will purchase from existing shareholders. So that's the secondary market. And the third way would be to purchase using a unit trust. And the unit trust is quite a cost efficient way to purchase because if you have to purchase on the GSE, you have to buy in batches or lots of hundreds of shares, and that can be quite costly. But when you're looking at unit trust, which are well managed, there is it's a pool of investor, and the shares that are being bought, it's a pool of assets or funds, and it's quite well diversified, and it is a very efficient way to invest. It is well diversified, which means that it minimizes the risk. So when you are buying at a small amount of money, but also you have a reduced risks. So a reduced risk because you are buying a quite well diversified portfolio, right? So these are the three. Obviously, there is a good read about technical and fundamental analysis. I want you to have this read. It's the best way to understand the investment side of things. You see, technical analysis will look more at trends, past trends. They will more analyze past data or performance of a company's share. They are looking at that and they are using it to predict how the share is going to perform in future. So they are looking at past trends, they are looking at how it can inform the future, right? Technical and um, fundamental analysis will do an inquiry at the fundamentals, right? Would look at the financial statements, the health, the management of the company, competitive advantage, competitors, market. They will look at all these things to see the difference between the fundamental value of a company and the current price of that company's share, right? So examine even beyond that, the economy, a particular industry. So the best way to put it is that it both should be used, fundamental analysis and technical analysis. And in red there, I have highlighted some of the most important things that you need really to understand. So in general, fundamental analysis will tell an investor what to buy or sell, whereas Technical analysis will indicate when to buy or sell. Quite important, right? So, but now let's go back again to our ratios. Gearing and investment ratio, very important. Gearing ratios, for example, should ring um, a bell all the time to you with regards to debt. And so here again is actually an understanding of um, the proper balance between debt and equity um, as means to obtain capital, right? So you want to obtain capital, you must understand that debt is less expensive but more risky because if you are going through economic turbulence or the company is not doing quite well, they are still obligated to pay the interest on those debts, right? Equity is more expensive, but it is less risky. So the whole thing is that there needs to be a proper balance for a financial manager, for you as a future entrepreneur, of how you are obtaining the capital to venture in the businesses you are going hopefully to be involved in. One such ratio is the debt to equity ratio. Straightforward. You're looking at the non-current liability or long-term debt divided by the total equity. And this does give an indication if a company is likely to pay interest payment requirements. So a low gearing ratio obviously would mean that the company does not have a huge amount of debt and is more likely to meet interest payment requirements on the debt, right? So the total gearing ratio is another one that we can look at. So we look at long-term liability, non-current liability, divided by the capital employed. And the capital employed would have equity plus long-term liability. So long-term liability is coming twice on the numerator and also as an addition to the denominator, right? It will give us an indication of the financial risk of the business. Are we having too many debts that we cannot service? That's what these ratios answer to, gearing ratios. Then we can look also at the market value ratios. Earning per share, we're looking at the earnings that is attributable to ordinary shareholders divided by the number of the ordinary share that have been issued. So that's the EPS, earning per share. Another market value ratio would be the price earning. So we take the market price per ordinary share issued divided by the earning per share. Price earning, price, market price divided by the earning per share. And what do these do though? They provide us a good indication. For example, in the case of earning per share, we're looking at the profit earned per share, the profit earned per share. It's quite a good indicator. Uh, Obviously, the more, the better, but we must also remember that the profit that is earned is not necessarily distributed as dividends to the shareholders. It could also be retained. So the part that is distributed is the dividend, and what is not distributed is the retained earning. Very important, right? So this ratio is also a ratio that drives actually the share price, right? It is um, also used in the price earning ratio, right? Because we use it here, right? So these are linked. So we use the EPS as the denominator for the price earning. Price earning measures the investor's confidence in a company. And it is quite a better tool than the earning per share on its own and the price on its own. That's why price earning is a better tool in the sense that um, we would be able to see if a low PE ratio would indicate that a particular share is undervalued or not, but it could indicate because it's cheaper. Um, but a high PE could indicate that the share is expensive, but also that that share is um, overvalued. So you could be more interested in a lower firm's PE because that could be attractive because you might see the potential, the future potential. But like I said, that's why a good read is important. And example 2.8 provides you that practical example. You have two companies with two different share price, one with a higher share price and one with the lower, company B. Company B could be attractive at um, high side. You might just look because it's cheaper, it's better to invest in. But actually, when you look at more information, you could see that in the end, when you're looking in terms of the number of shares that is in issues, true, given that company A is more expensive, the share price is greater. But when you're looking at the number of ordinary shares in issue, it's 10 million versus 30 million. Company B three times that, right? Um, and the earning though, the annual earning is exactly the same, 50 million. And so the earning per share for company A is 5, and look at the earning per share for company B. It's only 1 rand. So you can see why the PE of 10, although is lower than for company B, which is 24. And this can be a good indication that company A is actually a better investment prospect. So as I was saying, if you look in yellow, a low PE ratio is generally the preferred option among investors, as this may indicate that the stock is undervalued. As such, investors can capitalize on this opportunity in order to make a good return when the value of the stock increases. So it's quite important when you're doing this analysis to understand this. So this again when you're reading, I trust that this provides you good perspective, right? And there is examples and answers, but we want to touch quickly on the dividend yield, quite an important one. We want to see how much dividend is being retained. Sorry, is being given to its investors. So a company with high dividend yield may be considered risky. And there's a reason for that because we are returning, not retaining, we are returning a huge portion of the profit back to shareholders as a dividend. So, but the dividend yield, we take the annual ordinary dividend per share, meaning that if we pay twice or by annual dividend. We need to take the biannual. If it's 5 rand, we multiply it by 2 to obtain 10. So in this example, for example, you see this is quite a straightforward example. We take the annual dividend per share of 10 divided by the current price, which is the a price of 100 multiply by 100, which gives us 10%. So we can say that the dividend yield is 10%, right? And we say that it is risky when it's high if companies are having a high dividend yield. So it's it says something about the future growth of the company because if the company is not investing and leaving less profit for future development and growth, that is concerning, right? Dividend payout ratio. So this one I just show us the dividend per share divided by the earning per share. So we want to see the percentage that is being paid out as dividends. So obviously, if the percentage is, for example, 40%, we would understand that 60% is therefore retained. Only 40% is being paid out and 60%. So what we do, we take the dividend per share divided by the earning per share. Straightforward. Please look at this. And another one of my favorite, is the price to book value. So we have the market price, but we can also look at the book value per share. And how do we get this book value per share? We take the total equity divided by the number of shares. So very important. And in the theory is embedded an example. For example, suppose a company share has a book value of 10, but the market price is 15. 15 divided by 10 gives us a price to book value of 1.5 times, which means that investors believe the share is worth 50% more than the accounting record seems to imply. Okay, so there are limitations, obviously. Like I said, there needs to be taken into context. Financial statements are made easy to understand with the ratios. That's a fact. But companies also need to look at making this comparison with similar companies or industry averages, right? It also, they say that it enables a business to make informed financing, investment, and operating decisions, which I agree totally, right? There is example, uh, they the ratio analysis has also a number of limitations, and they are here on page 60. You can see the limitations, right? Companies can have different accounting policies, and so it's difficult to make the comparison. Uh, and some entities might be diversified in a number of industries. So management also can manipulate financial statements in order to make them more appealing to stakeholders. True, true. And all this can be quite subjective at times, right? It can be quite subjective, and that's why there is speculations, but everything should be understood in context. When you just have this good read, you will know how to put everything in its context, right? So there is an example 2.9. Uh, you are provided a very, very long income statement and even an annual cash flow statement. Remember, if I didn't put the solutions, you have access to the solutions and you can go and check it out, right? And I would have to say that that it's for this learning unit. So it's we really looked at the gross and net percentage. We understand the nature of element in the statement of profit or loss and other comprehensive income, understanding the concept of shrinkage and how it can be minimized, analyzing periodic and perpetual inventory systems, analyzing and interpreting financial statements with ratios. So, two things, please have a read. Please work through the examples and the exercises that are given. Please, when you are studying from now on, you need to have that practical side. Please take your assignment one, question number three. You will get actually ratios there that you need to work on. when you are reading this learning unit, work already to complete already assignment question 3. But next week we shall do the NSS National Support Session, and we will touch on the assignment and what you need to be aware of so that you are ready to submit your assignment by the end of this month. Again, good luck and keep up the great work.